Good evening, everybody. It is Wednesday, July the 13th. It's about 9 p.m. here in Toronto. The markets today, there are no words. You don't know if you should laugh or if you should run because you know something just isn't right. But let's talk about it. I'm your wealth guy. Let's talk money. Let's talk market wrap up. So let's just jump right into it today because we had some pretty bad news come out as far as CPI is concerned in the US, which came in at an unexpected 9.1. Keeping in mind the anticipated was 8.8 and the previous report was 8.6. Now, I've been talking about inflation for quite some time and how inflation is going to continue to move to the upside, and I am not done with that story yet. In fact, we're going to talk a little bit about liquidity later as a bit of a special report that I need to do here because I think it's very important to understand what can potentially come down the line. In fact, I think it's very important to understand what is coming down the line. But back to today's markets for now. So CPI came in at 9.1 and instantly the markets reacted very negatively right away in pre-markets. They turned very red. At one point, the markets were down as much as 400. And at one point, the markets actually turned green. That is absolutely ridiculous. Inflation comes in at a higher level that was anticipated, the highest in probably 40 years. And still the markets turned green at one point before finally finishing on the Dow down 208 points. The S&P was down 17, formerly back in bear territory. And the NASDAQ was down only 17 points. But that's not where it ends because here in Canada, we had an interest rate increase of a very unexpected 1 full percent. And how did the markets react? They were flat for pretty much the rest of the day, finally finishing down only 63 points. What is going on here? Well, I can tell you, it's actually the central banks back at work, working hard to buy up the debt. Because I'm not sure if you were looking at the 10-year yield today, but it dropped very significantly once again. Now, this is not retail investors. I've said it before. These are not retail investors buying up the debt market. Oh, no. These are central banks trying to calm the markets, trying to print more money into the markets to increase liquidity, which will only last for the short term, trying to do what I'm calling a controlled demolition of the markets. That's the only answer. The central banks around the world are buying everything. And whether or not we're going to choose to accept that and whether or not we choose to say, well, the markets and traders have already factored in the increase in inflation, already factored in a 1% increase in the interest rate in Canada. I think there's a level of truth to that. I think we were absolutely expecting more inflation. I think anybody who understands the simplicity of what's going on as far as small increments of inflation, of interest increases, plus printing money on the back end will have zero impact in restricting inflation, but will actually cause hyperinflation, which is exactly what we're seeing now. I think that factor has been taken into some consideration, but I don't think the markets had priced in 9.1. Oh, no. Otherwise, the markets, when they dropped 400 points, they were getting ready to fall so much further before, again, central banks stepped in. Now, this isn't the first time we've seen it over the last few weeks. We saw it after the last interest rate hike by the U.S. Remember the emergency tools that had to be deployed? Well, they're still being used. And God forbid we use the term quantitative easing because that has stopped. It's supposed to be quantitative tightening. Instead, we're using emergency tools now. and expect these emergency tools to continue to be used to stabilize the market somehow, although it's doing a very poor job. What it is doing is preventing rapid successive falls to the negative day in and day out. Instead, it's calming the market and slowing down a grinding, losing momentum here. So it is just going down slowly. Let's take a look at the rest of the market, because gold and silver were struggling a little bit today. They did pop to the positive quite significantly. Tonight, they are in the red. In fact, if we take a look at futures tonight, as overseas trading has started and therefore futures are open, we're looking in the red again right across the board. So the US 30 is currently down 116 here in the early session. And if we take a look at the 500, it's down another 20 points. So the markets are looking like they're going to continue their red momentum from today. No surprise, this is actually the momentum you should be expecting when you get horrible numbers. But I did want to talk about something that's very important. It was something I wanted to talk about on Sunday with my market preview for the week. But I didn't get the chance to. And the truth of the matter is, when I was reviewing all the information, it made it a little bit difficult for me to actually present it. So I had to write some of it down. So please excuse that I'm going to be looking down at my paper here, or my notebook. And what I really wanted to talk about was the contraction of the currency supply and what's coming as soon as November. And I'll tell you some of my sources. In fact, I'm going to post the link to the video for Arcadia Economics. If you don't follow their channel, I absolutely love them. They had a roundtable recently. Although I am not connected to them whatsoever, have a look at their video. They actually did a phenomenal job of taking this and expanding on it, and including precious metals, as many of them are metals guys. I think actually all four of them are very much metals guys. But either way, the information that they're talking about is not correct and is actually quite accurate. And I do have tremendous respect to all four panelists. But let's talk about the expansion of the debt market. So this money printing, this continual buying of the debt market is essentially money printing. And what happens is we are in an economy that is dependent on debt. And I don't mean that not only do retail investors and the average Joe need debt, but in order for the economy to grow, in order to either stave off a recession or pull ourselves out of a recession, we need to print money. And money needs to make its way out into the economy and into the markets. So the expansion of the debt market cannot stop. That is exactly why the Fed needs to continue to print, regardless of what they say in regards to quantitative tightening. They need to continuously and continually print money in order for this entire global system to keep going. That's including the markets, that includes the economies. Remember, the markets are essentially a derivative of the debt market. This entire system is debt-based. This entire economy is debt-based. The banking system is debt-based. The constant issuing and increasing of global debt is going to cause the increasing inflation numbers to go higher. It is not going to stop at this point. We've reached a very, very dangerous point where very little can stop the level of inflation now. The system eventually, however, will run out. There's only so much you can print. You can print into oblivion theoretically, but there's going to be a point where the money supply will have to tighten, where we will see the contraction in the money supply, and that's a very dangerous point. Because when the money runs out, the ability of central banks will no longer work. The currency supply will become saturated, and then the money system will contract. This contraction will not only affect and push economies into a recession, or even worse, because I already firmly believe that we are in a recession, but will also eliminate any chance for the central banks to provide any real assistance in terms of money printing. The economies need money printing in order to grow. As I said, it is a debt-based system. When the cash freezes up, economies will freeze up. Adding inflation into that, the Fed will be forced to pivot. And what do I mean by pivot? Very simply, they will need to drop interest rates as a last-ditch effort. But this is the 11th hour that we're in. The Fed is now focused on a soft landing of the economy, a soft, controlled demolition, as I mentioned, of the US dollar. Now when? Well, according to one of the analysts I mentioned earlier, Rafi Faber, it could be as early as this November. November 2022 is when, theoretically, and if his calculations and analysis is correct, we may start to see the contraction. Now, keep in mind, the contractions of this magnitude have not been seen truly since 2008, just before the crash there. Previous to that, in 1987, and previous to that, 3 months before, in 1929, entering the Great Depression. Now, does this mean that the markets will absolutely collapse overnight? Absolutely not. In fact, as I mentioned, even if we do see this contraction in as early as November, it'll absolutely force economies, and this will be on a global scale, into a global recession, and possibly as deep as a depression, with hyperinflation on top of that. This will be a slow demolition, as I mentioned. Essentially, the Fed needs to continue to buy what they can until they can't. And when they can't, they're going to try to keep all major investors in central banks. Remember, most central banks around the world are private. Help them exit their positions. Help major funds exit positions and leave people like you and I holding the bag of hot, steamy garbage. So what's next after that? Now, theoretically, if this happens, the eventual direction that the economy will take, or that governments will take, will be a centralized digital currency. Now, that does not mean necessarily the adoption of a Bitcoin or the adoption of Ethereum or any other of the current cryptocurrencies as we know. Oh no, probably going to be, and the reality is it will be something very different. If we take a look, the IMF has already started talking about implementing a central bank digital currency. The United States has been passing little bills to help bring that along as well. Here in Canada, don't sleep. All the little apps and the differences that are changing are also to help create the adoption of a central bank digital currency. And that'll be the direction that, if this contraction of the US dollar does take place, whether it's in November, in the beginning of Q1 in 2023, it won't make a difference. Eventually, the central bank digital currency will be the end. Eventually, the US dollar will no longer be the global reserve currency, as the IMF will form a centralized currency in the exchange. Possible gold and silver will become the standard. Eventually, the explosion to the upside of the the commodities market, and eventually the transition of all assets into a new structure of income, of savings, of control of currency. And that's only after we've experienced a deep depression, a very serious recession, and a contraction of currency. But that's the doom and gloom. As I said, I am going to link the video for Arcadia Economics down below. So please check out that video, have a look through. Very, very informative. I think you're really going to benefit a lot, especially if you want to learn a little bit more. They do show the charts that I've touched on here. I think they're going to do a lot better job than I did. This is really very much just a summary of a much, much deeper rabbit hole, an analysis that will truly give it justice. But that's it for tonight, everybody. This video is very long, I know. Please subscribe, like, share, but most importantly, comment. I'd love to hear what you have to say, and I would gladly respond back. That's it, everybody. I will see you tomorrow morning at the opening bell.